Hello and welcome. My name is Karen Croyle and I'm a Vice President with Balmoral Advisors. For those of you that aren't familiar with us, Balmoral Advisors is a boutique middle market investment bank specializing in M&A advisory and capital raises for companies in the chemicals and materials, building products, food and beverage, industrials, and plastics and packaging sectors. It is my pleasure to welcome you today to the Balmoral Middle Market M&A Outlook, the current state of the middle market and where we go from here. Before we begin, I have a couple of comments. All participants will be muted during the webinar. However, we encourage you to participate by asking questions that will be addressed at the end of the webinar. To do so, type a question in the Q&A box anytime during the talk. Our presentation will last for approximately 60 minutes. There will be time for Q&A at the end of the presentation. This webinar will be recorded and posted on the Balmoral website at www.balmoraladvisors.com. With that, I'm pleased to welcome Chris Cerimele, Managing Partner at Balmoral. Chris founded Balmoral in 2015 and has over 25 years of experience in investment banking, finance, and accounting. Chris has advised on more than $20 billion of primarily mid-sized chemical and industrial transactions. With that introduction, I'll get our presentation kicked off with the first question. Chris, what is the current state of the deal market and how has it evolved since the crisis first hit in March?
Well, thank you, Karen. And first of all, I want to say hello to everyone and welcome you. I know we have a lot of friends and clients and folks on the phone, so thank you for joining, and hopefully this will be informative for you folks. So what is the state of the deal market? I think I could summarize it by saying that it's slow but getting better. And those of you who know folks like us, investment bankers, we tend to be pretty strong workaholics. And it's been a little bit slow for the past couple months, and I'd say people are probably working on their TANs more than they'd like to. But things are evolving, and maybe the best way to answer the question would be to give a little bit of a history of how things have evolved since the current situation unfolded. So at the evolution of the market, this of course started in March. And first half of March, people were kind of wondering what was going on. By the second half of March, pretty much everybody had gone into lockdown and stay at home and things like that. In March, we still had deals that were kind of late stage that we're trying to get done. In fact, Balmoral had about 5 deals that we thought were trying to get closed by the end of March, sort of early April. And in the beginning, everyone was trying to push and get those done. And at the same time, on the other end of the spectrum, we had the new deals that were in prep that were going to market or that were shortly in market. And there was a lot of question at that point about whether those deals should continue or be put on hold or what we should do about that. And that sort of resolved itself because things got to a point where the market basically just kind of went on a pause. And so by early April, the market had pretty much slowed down to where about 80 or 90% of the market was on some kind of a pause or some kind of a hold. Basically, all the different deal participants, buyers, lenders, sellers, just got to a point where they said, you know what, we just need to put a pause on things and see how things develop over the next few months. And that lasted throughout pretty much April and May and maybe into early June. And now that we're into mid-June and kind of late June, we're starting to see a little bit more life. It's begun to parallel a bit the opening of restrictions among different states in the U.S. and in different countries, and the evolution. People are starting to travel more, they're getting out more. People have a little bit better sense for what this impact is having on the economy and to companies and outlooks and things like that. And so we're slowly starting to see things open up again. I'll give you some examples from our deals. As I mentioned, we had 5 deals trying to close by the end of March. All of them pretty much were impacted to various degrees by the situation, some more than others. So in one of the transactions, the main holdup was that they needed regulatory approval to transfer an air permit. And we didn't know if the government agency that would review that was even open. And they had 90 days to to make a decision. And since that time, they have come out and they've approved the permit, and now we're moving toward close. We had a couple of deals where we had a buyer get cold feet or a lender get cold feet, and we had to go and basically find replacements. Funny enough, the case where the buyer had cold feet, we ended up changing them out with another buyer at actually a higher price, which I don't know how that happens, but it did. So basically, and then we did have a deal close. We had a deal close at the end of May. It was KMCO, which we sold through a bankruptcy process. So of those 5 deals at the end of March, most of them pretty much went on some form of suspension or delay. One of them closed at the end of May, and then we may end up having a big June here with 4 closings as all of those deals are back on track and are pushing to close. On the other end of the spectrum, we had a couple of deals that were in prep stage, and we ultimately did decide in early April to put those on hold. And happy to say that we're actively talking with both of those clients right now about the possibility of restarting and relaunching in the next few weeks. So we'll see how things go with that. So that's kind of it right now. I mean, it's kind of gone through different cycles over the past few months. It was pretty low, pretty soft for a while there, but there are signs that things are getting better.
Thanks, Chris. Can you give us a little insight into how each of the key participants in the deal market, whether it's lenders, buyers, sellers, have reacted to these events?
Sure, Karen. And I think probably the best way to address this question would be to break it down into what I think of as sort of the 3 or 4 key constituents when we talk about the different parties to the deals. So on the one hand, you've got companies that were looking to sell or corporations that were looking to divest. Then you had corporations or companies that were looking to make acquisitions on the buy side and what they've done. Then you had lenders who, of course, support the deal market by providing acquisition financing, and then private equity firms. So I'll take each of those 4 kind of in turn and give you a sense for what we were seeing as the reaction to these different types of folks. So on the sell side, I think initially a lot of sellers were trying to keep deals going and keep processes going, and investment bankers were trying to keep processes going and keep things together. And again, I'm talking mainly in the March timeframe here. And then as we got into early April, it was pretty clear that it was just going to be very, very difficult to proceed forward with these. The late stage deals were hampered by, lenders pulling back and hampered by travel restrictions. And then what started to happen was that the companies began to be impacted by COVID in terms of the economic impact. And companies that up until March or maybe into April hadn't been seeing too much of an impact suddenly began to see things, to see it in their numbers. And that created a lot of uncertainty. And so it became kind of a domino effect to where people said, you know what, it'd be better off if we just hold off. The other thing that happened, frankly, we had some clients that said, well, maybe we can push forward through this. We were beginning to get responses from buyers, kind of questioning why we were still on the market. And you don't want to be, if you're a seller, you don't want to kind of be distinguishing yourself, along the lines of people thinking, well, what are they sort of thinking? Do they need to sell? Are they in a difficult position? So that whole issue of, why are you still trying to sell your business in this market where 90% of the other processes have been put on pause? That became a factor. And so folks decided, in large part to put things on hold if they could. There's also, some concerns about, okay, are my valuations going to be hit pretty significantly? And we're going to be talking about that later on in this webcast, but that became a concern as well. So there was sort of cautious, frustration on the part of sellers because they would have preferred things to go forward, but realization that it was time to put things on pause. On the corporate buy side, a lot of the discussions we were having with our sellers was saying, well, the large corporates that are out there, they don't need acquisition financing. They have a lot of cash. maybe we should continue to focus on strategic buyers and would they be there? And in our discussions with large strategics and how they were reacting to the market, it was a little bit mixed. And so you did have companies that did have strong balance sheets and strong cash positions, but they weren't focused on using it for acquisitions. They wanted to preserve cash to make sure that they themselves could get through the current situation without liquidity constraints. So in the beginning of this, you saw just sort of a general pullback and a general conservatism, even on the part of corporate buyers. Not all. And we have some corporate clients who we represent on the buy side. And frankly, their boards were challenging them to use their balance sheets, and still are challenging them to use their balance sheets. Not because they're looking as vulture investors to pick things up at super cheap, but frankly, just because there's more opportunity, with perhaps less competition from other buyers in the market. The third constituent of the market is the lending community. And they had a fairly significant impact on the market, especially early on. So the lending community had to be faced with the fact that their portfolio companies in many cases were struggling as a result of the economic impact from COVID. And so in the beginning, certainly, they were all pretty much internally focused. And you can distinguish between bank lenders and non-bank lenders. Certainly the bank lenders were very focused on their portfolio companies, but the non-bank lenders were too. They had large percentages of their portfolios that were in non-compliance or facing liquidity issues. You heard the stories about companies drawing down on their lines of credit, even if they didn't need the cash, just to make sure that they had it, things like that. And so in the face of dealing with all of that, the lenders basically put their new deals on hold. And we saw, certainly in the beginning of this environment, where lenders were either pulling term sheets or revising term sheets, or just telling folks, listen, we're going to just have to be on the sidelines for a little while. So they've been very cautious. We're going to talk a little bit later about distressed deals. So I'll pause there on the lenders and we'll come back to that. And then the fourth category is private equity. And as with lenders, private equity firms, in the beginning were very focused on their own portfolios. Priority number one was making sure that they were stable, that they knew what the reaction was going to be economically to the COVID situation, helping companies with their liquidity, securing PPP loans if they needed them, securing other financing if they needed it. And so for the first, I would say 4 to 8 weeks of this, they were pretty focused on that. And because the lending market had dried up and because of all the uncertainty, they were basically putting new acquisitions on pause. We were getting a lot of private equity firms basically telling us, listen, we're very interested in the sell-side process that you've got going on right now, but this timing, we just have to put things on pause. If you halt the process and restart later, please contact us because we're going to be interested. But right now is just not a good time for us. So that kind of happened through late March into April. But there's still something like $2 to $3 trillion of capital committed to private equity, and they're in the business of doing deals. And I'd say that their interest, their fundamental interest in doing deals never really stopped. We're beginning to see what we're sensing is more confidence in the private equity firms and being able to come back and do deals now that they've stabilized their portfolios, and they've taken care of that for weeks now, if not a month or two. And so now they're more outwardly focused and looking at opportunities and we're getting requests about, are you going to be restarting your process? How are things going? What are you seeing? And so forth.
Thanks, Chris. Given the responses of these key participants in the market, has there been a change in the way that deals are structured to cope with these key participants' pain points?
Yes, that's a great question. And, it's a little bit difficult to tell because, when the market was down and 80 to 90% of deals were put on pause, it was a little bit challenging to be able to say that there was sort of a widespread change in how people are approaching things, but there were a few things. And first I want to make a note about how people were approaching deals in general. So, in the beginning, we had the travel bans, and people couldn't travel. And so then the question was, how can you get deals done to begin with? Does that affect things? And what we found was that Zoom calls are great, and it's fine to put a GoPro on a drone and do a tour of a facility or a site, but there's only so much that you can do without actually seeing or meeting in person or touring a site in person. So from the deal execution standpoint, people did what they could, but there were just certain things that needed to be done. And so during this time period, one of the reactions that we saw, certainly with some of these deals that I mentioned that got delayed, that were late stage, is people continued to do their due diligence and continued to negotiate and basically said, listen, we're going to do everything we can up to the point of eventually we're going to need to see the facility in person, or we're going to need to have an in-person meeting. So that's one aspect of it. The other aspect is, how do you deal with the economic uncertainty? Can you get a deal closed right now if you don't know what a company's outlook is? And that becomes a challenge. And so there are ways that people can deal with it and are dealing with it. And there are things like earnouts. There's contingent compensation on contingent purchase price. We've seen some use of seller notes and things like that. On the private equity side, people have talked about the idea that, well, if acquisition financing is scarcer and the credit markets aren't quite open up yet, then what can we do? Can we fund a deal with all equity and then finance it out later when the debt markets come back? Or can we put a little bit more equity into a deal and make it easier for a lender to come into a deal? And so there's been a lot of talk about that. I personally think that it would be harder for a private equity firm to close a deal with 100% equity and not do any acquisition financing and wait until the credit markets come back, simply because at least when we were in April, May timeframe, you had no idea when the credit markets were going to come back. So as we go into the next few months here, there might be more visibility on that, but that's been an issue as well. So people trying to work around the fact that there's so much economic uncertainty with non-cash structures to their deals.
Well, switching gears a little bit here, and I think this is probably a question that's on most participants' minds. What's happened to valuations in this market?
Yeah, that's the $1 million question, or the 10 million or $100 million question. So there's sort of the intuitive answer, which we'll give, and sort of evidence based on what we know. It's hard to know for sure because there's just not a lot of price discovery in the market right now. There have simply been fewer deals getting done, and in some cases, the deals that are getting done, well, in many cases, prices are not being announced. You're not seeing valuations. So this is a little bit of reading the tea leaves here. If you had asked me this question in April or May, I would have basically said that there is no price, that there is no valuation right now because deals just aren't getting done. But there are a couple of things that we can point to help answer this question. So number one is the impact of the more conservative lending market. And this is something that we saw in the Great Recession as well. What we're hearing from lenders is that the ones that are open for business and that are looking at deals are telling us that at least in the foreseeable future, they're going to be reducing the leverage they put on new loans. So the days of the deal that was financed with 6 times EBITDA, that's going to be gone for a while. In the mid-market and the lower mid-market, what we're hearing lenders say is that they'd probably be capping out at kind of 3.5-ish leverage. And you'll get some that are higher and some that are lower, but multiples have probably come down, at least 1 to 2 times. So if leverage is an important factor in pricing a deal, for example, with a private equity firm, then that may influence the price that they're willing to pay unless they're willing to fill in the gap with equity, as I mentioned a few minutes ago. So that's one aspect of it. Are there declines in actual, sort of absolute multiples just on earnings performance? Same level of earnings today versus 6 months ago. Is the multiple, higher or lower than it was? Well, it's probably not higher, but I think what's more relevant is just the performance of the companies in many cases, not all. I mean, some companies have done very well through COVID, but I would say most of the companies that at least we deal with have had their performance negatively impacted by COVID. And so now what you're seeing is basically, even if it's the same multiple, but you're seeing a lower earnings base, and that's going to affect valuations. So, I guess what I'm saying is that intuitively, does it feel like there are reasons that valuations could come down? Yes, but there are also just financial performance of companies has softened a little bit. And so that's going to need to be addressed with companies coming back. We'll talk about that a little bit in a few minutes also. But I think that's the best way I can answer it. Until it'll be easier to understand where valuations are once we're sort of a month or two out, I think, and activities picked up even more.
Great, thank you, Chris. Very helpful. Can you talk a little bit about distressed opportunities? Given the current market dislocations, are there a lot of distressed opportunities out there right now?
Yeah, that's a great question, and we get that question all the time from folks who are saying, gosh, you guys must be just so busy with distressed opportunities right now. And it is true that the last deal that we closed was a sale in bankruptcy with KMCO, which closed at May 29th, I believe. And it is true that we're in the market right now with a refinancing for a company that's in financial distress. Both of those situations were pre-COVID though, and we've been working on them for some time before the current situation. But like I said, it's a natural question of saying, okay, Chris, you just said economic performance is down. You just said people are focusing on their portfolio companies. Where is the distress? Is it there yet? And what I would say is, if it's coming, it's going to be in Q3 and Q4. And that's based on our own observations, and it's based on discussions with banks and other lenders and private equity firms and attorneys. And I mean, just to put it in perspective, I mean, probably about 40% of Balmoral's practice, deal flow and deals that we do have some form of distress or special situation to them. So it's an important part of our business, and we keep close tabs on where that stands. We speak to the special asset groups at banks and lenders. We're actively involved in the Turnaround Management Association. So I feel like we've got a pretty good sense on this. So why is it that there's not so much going on right now, but Chris, you're saying that it's going to be more like in Q3 or Q4? Well, it's a couple of things. So when this first hit, of course, everyone was focusing on their financial performance and things hit. A couple things happened. One is the government stimulus programs. So the CARE Act, and we're talking about PPP, and we're talking about the SBA's disaster relief loans, and we're talking about the Main Street. Well, Main Street hasn't really kicked in fully yet, but the point is that the government was supporting many of these companies, and that removed the urgency for 8 to 10 weeks. The other impact was that lenders in the beginning certainly continue to work with their loans and work with their companies. And I think part of it was a practical consideration. Part of it was just smart business, and people, basically instead of taking aggressive action against a fairly significant part of their loan portfolio, they basically said, look, let's just sit back and give this a couple of months to play out. So what the lenders did was they essentially pushed out forbearances about 90 days, in many cases to the end of September. So they gave these companies a lifeline and reduced the urgency. They haven't been sitting on their hands, because in the meantime, many of these banks have been aggressively beefing up their restructuring groups and their internal, they call special asset groups. And actually it's an issue because since the Great Recession, these banks have cut back on these departments quite a bit. And so now they're having to transfer people in and train them, but they're in the process of beefing them up. At the same time, folks that do restructuring consulting, I'm talking about folks that come in and be there as chief restructuring officers, or they'll do 13-week cash flows. Those folks have been in these companies since April and May. And so for us, those two events, the banks increasing their restructuring groups and the restructuring consultants coming in and doing their work, for us as transaction advisors, that tends to be a leading indicator. And so if it's going to happen, and the banks themselves are telling us that if it's going to happen, it's going to happen. And, originally they were saying July, August, September, but that's kind of the idea. The other factor that may make a difference here, frankly, is June results and June covenant tests, because that's going to help separate the wheat from the chaff in terms of which companies have been able to fare better than others during this whole COVID experience. So my guess is, or the consensus that I've gotten from everyone we've spoken to, is that if distress is going to come, it's going to be July, August, September. And I say if, other folks say it's coming. The reason that I hedge is because my experience during the Great Recession was that at that point, people thought that defaults were going to go through the roof and tons of companies would be filing bankruptcy. And don't get me wrong, there was restructuring activity, as those who were there will remember. It just wasn't sort of an open the floodgates kind of a situation like people thought it was then. And I think people do feel like it's going to be a little bit open the floodgates in the second half of this year. But I guess from my perspective, based on experience, I'll wait to see it. So when it does happen, from a transaction opportunity, I really see that there are going to be kind of three different opportunities. One is going to be distressed M&A, either in court or out of court. It'll be some form of recapitalization, lender takeouts, or junior capital raise, or equity infusion, or it could simply be banks selling distressed loans to third parties. So from our perspective, those are the sort of transaction areas that we look at when we think about distress. So we're closely monitoring their situation. I would say, stay tuned, be patient, but if it's going to come, it's coming soon.
Thanks, Chris. Another kind of $1 million question here for you. What will it take for the market to come back?
Yeah, that's a good question too. Thanks, Karen. So the market to some degree seems to be kind of mirroring society. So society kind of went into bunker mode in late March, early April. It's coming out a little bit in June. And frankly, as I mentioned, I'm delighted by the fact that we could have 4 deals closed in June. Every time we check and we have a discussion about it, we're challenging each other. Are you sure? Are you sure? And we'll see what happens. But so far, all systems go on those. We're also seeing new inquiries about new transactions. In fact, we were just engaged on a new transaction just within the last 2 weeks, and we've seen new opportunities come up. So it's thawing. Let me put it that way. There's no floodgates yet, but what will it really take for things to return to normal? It's a lot of the similar things that mirror society as a whole, but specifically to deals. Number one, travel ban restrictions will help quite a bit. We literally have one deal where our seller, who's a corporate, will not allow third parties onto their facilities. And so thankfully, the buyer in that case is actually okay with a video tour of a facility. That's the first time we've seen a deal like that where somebody's comfortable closing just with that. But the easing of travel restrictions will help quite a bit. I think the biggest, a really big impact is also going to be some return to economic stability and predictability. The hardest thing about this whole experience for the M&A market and the capital markets has been the lack of certainty and clarity on economic performance. what we're going to need to see is we're going to need to see companies having some confidence in what the rest of 2020 is going to look like and what 2021 is going to look like. It doesn't have to be, hey, things are going to return to pre-COVID, but it just has to be some certainty that we know pretty good that this is what it's going to be. And if the performance is not here, but it's here, that's okay if you're pretty confident that it's going to be here. And that's going to make it much easier for buyers to set prices, do their financial analysis. It's going to make it much easier for lenders to provide credit. And it's just going to make things a whole lot easier for everyone. So those are some of the key things that I think are going to be needed.
Well, I guess given all of that, what are some of the things that one should be thinking about if they're thinking of buying or selling a business right now in this market?
Yeah, that's a good question. So you're asking all very good questions, Karen. So I would say that the thing that you just need to keep in mind is that we're not out of the woods yet. It remains to be seen how quickly will things recover. Is there going to be a so-called second wave of COVID, and what's that going to do? So there's still uncertainty about what's going to happen going forward. What you need to be thinking about, what I would say is if you are very interested in commencing a process this year or in the near term, then the best thing to do, and I know this is going to sound self-serving, but it doesn't have to be us, but engage an advisor sooner rather than later, because an advisor can help you think about how to deal with the effects of the past several months. They can help you think about how to position the company's performance going forward. They can help you think about, market timing. Is this good or not? Are there things that we can be doing to the sale process to be thinking about things? And even if you engage somebody now and you don't launch for a couple of months, it's still worth the time and the investment. And I'll give you some examples of some things. So, in the deal market, they talk about, add backs and adjustments and things like that. And there's been all this talk about a COVID adjustment. And for those of you who have seen this, there's a picture of a mug on LinkedIn that says EBITDAC, EBITDA and then COVID. If I see that one more time, I'm going to slit my throat. But anyway, the idea though is a sound one, which is basically saying, let's look at the company's performance over the past 2 or 3 months during this cycle and try and measure and quantify what the impact has been of the downturn because of COVID, for lack of a better word, and try and quantify it in a way that is that makes sense, can be defended, is auditable, and in some cases maybe bring in an accounting firm to help with that, do a quality of earnings if you need to. But the reality is that everybody knows that things were tough over the last few months, and so having an adjustment, people, I think in general, the market is going to expect an adjustment. It's just going to be a question of, okay, how are you calculating it? How are you quantifying it? Does it make sense? And there may be some negotiation or some closer examination of that. The other thing you need to be thinking about for financial performance is looking at your next 6 months to 12 months and having an honest and sober assessment of what you think performance is going to be. And if you have no idea right now, then that could be a sign that maybe you ought to wait a little bit. But the more certainty that you have and the more that you can provide evidence or justify it or make the case, and again, it doesn't mean that your performance needs to be equal to pre-COVID. In fact, if it is, people may, that may raise questions or invite additional scrutiny. So I think most, buyers will accept the fact that your performance might be a little bit lower in the next 6 to 12 months. But the question is, do you have, a good, sound rationale and methodology for estimating what you think that's going to be? There are other things that you could be thinking about. Has the post-COVID world, changed your business environment, and how? And can you take this time to think about strategizing what your post-COVID strategy could be to grow the business, things like that. So I think it's a lot of preparation. It's a certain amount of patience. And again, whether it's us or someone else, I would encourage you to speak with an advisor.
Thank you, Chris. Given everything that we've discussed here, are you optimistic or pessimistic about the near-term future?
Well, I think, having been an investment banker for so long, I find that it helps in this business to be an optimist, but I do think that there are reasons to be optimistic. I'm certainly feeling a lot better about things than I was last month. What's going to happen with the COVID case rate? Is there going to be a second wave? I have no idea. But what I'm optimistic about is that regardless, people seem to be finding new ways to cope with the situation that are maybe less intense than they were in March and April. And people are finding ways to get deals done and to work around things. And so, and it just feels to me like things are getting a little bit better. No, they're not there yet. I mean, our firm is still working from home, and we intend to be doing that at least till the 4th of July. And we don't expect, to be traveling widespread or anything like that, but we're certainly optimistic that, activity is going to be better than it was in the last few months. Is it going to get back to, the levels that we had at the beginning of the year? That's going to take some time, but you also have to remember that, through the end of February, I mean, that was one of the longest bull markets for M&A that I think anybody had ever really thought of or expected. I mean, I think it was something like 7 or 8 years, since the Great Recession, that we were just having gangbuster M&A activity. So there is demand for deals, both from buyers and sellers. I think there's wariness on the part of sellers about people out there looking for, distressed, deals or taking advantage of sellers. But I think that there are also a lot of buyers out there who are legitimately just looking for good deals, and they're not looking to sort of pillage. So again, we'll see, but things are better now than they were a month ago, and I tend to be optimistic that things are going to continue to thaw.
Great. Well, thank you very much, Chris. I guess switching gears, we have a couple of questions here from the participants.
Sure.
The first one is there any particular reaction of yours related to the oil and gas sector?
Yes. The oil and gas sector is, that's been a tough one during this time period. Oil and gas got hit a whole bunch of different ways. So yes, we had the COVID impact, but then you had the Saudi Arabia, Russia, dust up, and then you had the whole situation with air travel being down and jet fuel purchases being down. And obviously everyone remembers the story about negative oil prices and things like that. So the oil market in particular went through a tough couple of months there. I'm certainly very encouraged by $40 oil that we started to see late last week. I don't know where it is today, but things are certainly looking up on that front. As things thaw, I believe that, again, people get out more, they start to travel more, just general economic activity picks up. I think things are going to get better. So I'm more optimistic. I think it feels like the oil and gas market is in better shape now than it was a month or two ago. I also firmly believe, and we have several clients, including right now, who serve oil and gas as a significant end market. What I find, as far as the deal market goes, is that investors in oil and gas, if they're smart, they tend to have a longer term view toward that market, and realize that if there's going to be any kind of economic activity, then prices are not going to be sustainable at these levels. And so I think the I'm not an expert, I'm not an economist, but I have to believe that the long-term outlook for oil and gas is strong. And so as a result, I think it's a good opportunity right now.
Thank you. Next question here is, Are there any particular industries that you think there's a higher potential for deals getting done in the next 6 to 12 months?
Well, that's a good question. I think there are certainly industries that are harder than others right now. And what we've observed through this whole experience is that there have been sectors that have also been doing very well during this period. So food and beverage has held up pretty well. Parts of healthcare have held up pretty well, not everything. Obviously people hear the stories about hospitals and things like that, but we're not specialists in healthcare, but we have friends who do deals in healthcare, and they've been busy as ever. So I think it depends a little bit on, industry's reactions to the whole situation. But, again, I think that oil and gas is a buying opportunity right now. Certain other sectors, automotive and aerospace, I'm not so sure. Those seem to have a little bit, certainly short-term issues, maybe medium-term issues, let me put it that way. But I mean, the chemical sector, for one, has been doing pretty good. The packaging sector has been doing pretty good because it's supporting food and beverage. There are a lot of industrial companies that seem to be doing okay. Not great, but doing okay. What we have to think about also from a U.S. perspective, and again, I'm not an economist, but certainly I think people realize that this experience has exposed reliance on foreign country, on manufacturing overseas. And we're certainly hearing things about reshoring and things like that. So again, I mean, I personally think that in my mind in particular, aerospace and automotive tend to be tougher industries right now, but there are other opportunities that are pretty strong.
Great, thank you. Chris, it's impressive that you've been able to get a transaction done in this environment. Can you tell us a little bit more about the KMCO transaction that you alluded to earlier in the presentation?
Sure. Yeah, KMCO was an interesting transaction, and we're delighted. We actually have had quite a bit of interest in that transaction, and I think I'm not sure why. Maybe it was because we actually got a deal done in this market and we're active. The other thing about it was done as a Chapter 7, which is a little bit unusual. And so, the KMCO story was a tough one. We've been working on it for some time. I mean, maybe the question is what happened and why did it go Chapter 7? So instead of Chapter 11, which was sort of the original thinking. I mean, KMCO, and this is public record, but they had an unfortunate situation with an explosion and a fatality in early 2019. We were brought in, to help advise on the situation and help them find a buyer for the plant who would restart the plant and bring back the employees and bring back the business. And there's a whole long story to it. And we ran a process, and the original thinking was that we would be signing up a stalking horse and selling it as a Chapter 11. In the end, because the credit markets were so challenged, we didn't do it that way. At that point, it looked like a DIP loan was going to be very, very difficult. So, at that point, the company decided to go through a Chapter 7. At that point, they met with the trustee and said, listen, we have an interested buyer here on the table. They're willing to do the deal. They're still willing to do the deal. They can move quickly. And after discussion, they ended up selling. The trustee ended up approving that deal and getting it done. So it was an interesting deal. What we really like about it is, as I mentioned, we have a fair amount of our practice is in distressed. We do a lot of early stage growth as well. But I would say, but this is an example of a distressed deal. And whenever we come across those, we like to keep score on how many jobs, we save. And it's not clear, how many, we don't have an exact number in this case, but what we do know is the buyer of the business is someone who is intent on investing in the plant, restarting it, and bringing back the business, which is going to mean jobs for the area, which is a win for the community. So, and just another reason for us to be happy with the outcome.
Great. Sounds like a very interesting transaction, and congrats on getting that done. Chris, I want to thank you for your time and insights this afternoon. I think this has been very informative. I want to thank all of our participants for joining us. This webinar has been recorded and will be uploaded to the Balmoral website. And if you have any additional questions, please feel free to reach out to either Chris or I. Thank you very much and have a great afternoon.